and given by Jeff Puffer, Senior Vice President at Delphi Business Properties in Van Nuys. Thank you, Bart. Next slide. San Fernando Valley is comprised of 4 or 5 main areas. Notably the north, Santa Clarita Valley, including Valencia, Newhall, Santa Clarita, and Canyon Country. To the west, we have the West Valley, infamous Chatsworth, Canoe Park, you see what goes in. The East Valley has some of the lowest vacancy of all sections of the San Fernando and Santa Clarita Valleys. In addition to the Tri-City area, which includes Burbank, Glendale, was posting the highest pricing in the area, most likely due to the studios and the entertainment market that is strong over there. Last but not least, a little bit of LA, market down the line. Almost all the San Fernando Valley is located within the jurisdictional boundaries of the city of Los Angeles, with the exception of a few incorporated cities such as Burbank, Glendale, San Fernando, and the city of Santa Clarita. The San Fernando Valley also boasts almost 70% of all the county's motion picture and sound recording industries. San Fernando Valley is also the 3rd largest industrial market. So it comes from the total square footage between building in central Los Angeles and South Florida markets. The majority of buildings in our marketplace were built before 1979. No clearance, only dock-high loading, sprinkler. As a result of these characteristics, many of these buildings are becoming, especially the larger ones, functionally obsolete in the market. For 2011 statistics, we've got a little over 176 million square feet. Vacancy rate's about 6.5%. If we extrapolate the data from the Santa Clarita Valley, San Fernando Valley falls probably percent and a half lower than that number. Total gross absorption is a little over 1.6 million. This is an increase over a negative absorption of a little under a million square feet in 2010. The average lease rates, asking rates about 55 cents per net, actual rates about 51 cents per net. Both numbers in 2010 about 9 to 13%, expected lower than prior year's numbers. Sales pricing, we're seeing, our market's seeing actually a pretty good decline in sale pricing. The asking rate in 2011 $112 a square foot. 2010 numbers, approximately $130 a square foot. Again, for those large buildings, our comp rate a little bit higher than last year. We're seeing especially towards the end of the year, a lot lower comps going forward. We were about 15% higher than 2010 those numbers, but we're seeing pretty considerable decreases from there. Regarding these slides, you can see in terms of new product coming to market, leasing and sales, in terms of square footage, we've got an increase across the board. 2010. Our market is primarily composed of a lot of smaller size buildings. We don't have big massive hotels. There are enthusiasts, but the majority of buildings, as you can see, in terms of new buildings coming to market, the smaller size buildings will really lead the way in terms of listings and transactions this year. Last year too. In terms of the new sale listings, pretty flat last year. It was up 11% from the year prior. A little bit of an alarming trend you see on the sale transaction. Volume in terms of square feet from 2011. We're seeing a pretty good drop there from the first quarter of 2011 to the fourth quarter of 2011. It's dropping off quite considerably, and I think it's most notably due to pricing. We're seeing a lot lower pricing these days, which is fueling activity a little bit in that regard. Next slide, please. In review, we've got, in terms of leasing, we've seen vacancy decreasing 7.5%, and that is a combined number of Santa Clarita Valley 6.5% in the fourth quarter of 2011. Again, if you take out, extrapolate the data from the Santa Clarita Valley, we're a good percent and a half lower than that in the Santa Clarita Valley. We're seeing a lot more long-term leases being consummated. And tenants are getting more comfortable with their business numbers and lease rates these days, and they're, instead of doing short-term renewals, year to year, they're actually doing 5 to 10-year deals these days. We're seeing, as a result, we're seeing pretty competitive market pricing out there. The average in 2010 is about 63 cents a square foot, triple net. 2011, we've got a price of about 55 cents triple net. Third and fourth quarters, the activity increasing. We're seeing less tenant incentives being offered by landlords that are consummate deals. Increased sales activity in 2011, probably due to the near all-time low interest rates. The Fed came out today, promised hold rates steady for 2014, I believe. Hopefully that'll help fuel the activity for the next couple of years. We're seeing non-SBA loans come back. Obviously, the fees for the SBA loans are back in force. We'll see a lot more non-SBA loans being chosen by buyers in the market. I think a big little bit here. Short sales become a lot more prevalent in the third and fourth quarters of 2011. We're seeing a lot. It's having a big effect on pricing, appraisers, and so forth in the marketplace. Things are getting a lot. They're easing the restrictions and letting properties go. They're taking losses. Those comps, buyers are learning about them. Their expectations are coming down, and the transactions are following. Owner users, the aggressive sale pricing. We got $130 a square foot in 2010 versus $112 in 2011. That number, I think, is considerably lower today by at least $10 a square foot. Owner users, investors starting to come off the sidelines due to lower pricing. In terms of businesses, we're seeing better tax returns, maybe better credit deals, and fuel activity. Next slide, please. Lease project, we've got a 113,000 square foot deal, went out for 41 cents gross. 3-year deal, consummated first quarter of 2011. Natural Balance Pet Foods took it. They're the ones who have the little dog float and roast parade. Colliers rep and landlord was our company in Delphi. Next slide. Sale project, one of the larger deals that went down in our business in our market this year, 167,000 square feet, 500. Went down for $107 a square foot. Consummated fourth quarter 2011. Video equipment rental took it, and Lean Associates rental buyer CB was on the tenant side. This was originally marketed as a redevelopment opportunity, but with the high price based on the land, it went to the user. Next slide. This was one of the few constructions we have in our market right now. Is a build-to-suit. FedEx took it in the third quarter, 240,000 square feet. Fisher & Company rented CB was on the seller side and buyer side also. Next slide. 2012 market forecast, lower vacancy rates due to improving fundamentals. Pricing and financing bounce off the bottom. Leasing market will stabilize. Fewer tenant incentives. Rates will slightly increase from 2011 levels. Sale prices will continue to decline due to REO and short sales. Rating comps down, expectations down. Owner users become more active due to attractive pricing and low interest rates. And last but not least, investor demand to increase due to low cost basis and upside in future rental growth. So in summary, I think we'll see more activity, lower sale prices, and a little higher lease rates in 2012. Thank you very much.